Welcome back to StockScope. Today, we are executing a forensic audit of Salesforce's full year and fourth quarter fiscal 2026 performance. The market has severely punished this stock over fears that generative AI will completely dismantle the legacy software seat license model. But the raw numbers tell a far more complex story of structural transition. Salesforce is actively shifting its architecture from a deterministic human operator database to an enterprise operating system processing autonomous non-human workloads. We lay out the engineering of the financial statements, you decide the final verdict. Let's look directly at the top-line foundation. For the full fiscal year 2026, Salesforce generated $41.5 billion in total revenue, up 10% year over year, or 9% in constant currency. Q4 alone delivered $11.2 billion, a 12% increase. But the core metric that defines the long-term structural moat is the total remaining performance obligation, or RPO, which has crossed $72.4 billion, expanding 14%. Current RPO stands at $35.1 billion, though we must note this includes a 4 percentage point inorganic boost from the Informatica integration. Moving to the income statement, we see a massive 14% structural gap between GAAP and non-GAAP efficiency. GAAP operating margin landed at 20.1%, while non-GAAP operating margin surged to 34.1%. As analysts, we must reconcile this divergence. Stock-based compensation remains a major lever, compressing GAAP figures by 9%, while the amortization of purchased intangibles impacts margins by 4.1%. Meanwhile, the high-margin subscription core remains resilient, with Q4 subscription and support revenue up 13% to $10.7 billion. To defend its equity value against market skepticism, Salesforce is deploying an aggressive capital defense program. The company generated $15 billion in operating cash flow and $14.4 billion in free cash flow during fiscal 26, growing 16%. They returned nearly the entirety of that cash, $14.3 billion, to shareholders via $12.7 billion in share buybacks and $1.6 billion in dividends. Most importantly, the board has authorized a brand new $50 billion share repurchase program to weaponize their cash flow, alongside a 5.8% hike to the quarterly dividend. Now let's look at the engineering underlying their AI strategy. Autonomous AI agents are useless without deeply unified enterprise data pipelines. This is Salesforce's true hidden moat. In fiscal 26, the Data 360 platform ingested a staggering 112 trillion records, a 114% spike year over year. Crucially, 53 trillion of these records were processed using zero-copy architecture, a 310% increase that allows real-time data federation without complex database migrations. Add 18 terabytes of unstructured data processing, and you see that Salesforce has locked down the enterprise data layer. This massive data gravity is directly feeding the rapid scale of non-human workloads. Agentforce and Data 360 annual recurring revenue has breached a massive run rate, with the specific Agentforce ARR hitting $800 million, up an explosive 169% year over year. Salesforce has closed over 29,000 Agentforce deals since launch, expanding 50% quarter over quarter. This is translated into 2.4 billion Agentic Work Units executed across the platform, with inference volumes expanding 5 times over to 19 trillion tokens processed. However, a forensic review reveals a stark divergence across different segments. The legacy core is decelerating. In Q4, constant currency growth for Agentforce sales was soft at 8%, and Agentforce service crawled at 7%. Worse, marketing and commerce experienced an organic contraction of -1%. The top-line numbers are completely rescued by the Agentforce 360 platform and Slack segment, which skyrocketed 37%, heavily propped up by the platform expansion and the inorganic consolidation of Informatica. This brings us directly to the structural bear case. First, headcount disintermediation is a real terminal risk. If autonomous AI agents become hyper-efficient at customer service and sales workflows, corporations will downsize human divisions. This directly threatens Salesforce's high-margin, per-user seat licensing model. Second, the organic core is stagnating, with marketing and commerce in negative territory, making top-line metrics artificial and heavily reliant on continuous M&A. Finally, changing corporate infrastructure into an agentic enterprise creates immense macro sales friction and elongated corporate timelines. Conversely, the bull case points to complete monopolization of enterprise business logic. First, the 112 trillion records inside Data 360 create absolute data gravity. It is virtually impossible for an enterprise to deploy external language models efficiently without taprooting into Salesforce pipelines. Second, value conversion is scaling cleanly. Over 60% of Q4 bookings are originating from existing customer expansion, proving strong product-market fit and upsell momentum. Lastly, the massive $50 billion buyback authorization acts as a permanent corporate backstop against short sellers. Looking forward, full-year fiscal 27 guidance projects total revenues between $45.8 and $46.2 billion, a 10 to 11% constant currency expansion. This contains roughly a 3 percentage point inorganic premium from Informatica. Profitability guidance is tight, targeting a 20.9% GAAP and a 34.3% non-GAAP operating margin. Management's core thesis rests on a back-end hockey stick, explicitly promising an organic revenue re-acceleration in the second half of fiscal 27 as pilot projects mature into production contracts. If management executes this transition successfully, the long-term horizon looks remarkably secure. Salesforce has officially raised its fiscal year 2030 revenue target to $63 billion. With a massive $72 billion total backlog already written into contracted commitments, the bottom-line expansion is strongly protected. The platform is successfully attempting to swap volatile, deterministic human seats for sticky, predictable, automated computation logic processing. Turning strictly to the weekly price chart, the technical macro framework reveals a clear asymmetrical setup. Following a punishing sell-off from historical highs near $380, the price has collapsed straight into a massive historic resistance level around $164, established back in 2023. Under basic technical engineering, this multi-year-old resistance is acting as major structural support. Volume is consolidating, and the asset is heavily oversold relative to its cash flow generation. With a defined technical target price set at $260, the risk-to-reward ratio at these levels is highly compelling. The data is on the screen, the data gravity is real. We've completed the audit, the final decision is yours. See you in the comments.